Yeah, so welcome to episode 58. We're doing an AMA today. And of course, as always, we're going to drop down in the timestamp the actual question so that you can find a question that you like. And we're going to start with a good friend, Ed Mudzell is in the house. Sorry, Ed. Good buddy of mine that I've known for a few years. So Ed, take it away.
Yes, sir. I know you love these kind of questions here. So I heard this from a good friend of mine who's a top operator, big time operator. And he told me about this technique. And of course, I wanna run it by you.
First of all, anytime you have a technique, it's probably not a good.
Yeah. You know, it goes under how do I get around this clause, you know?
All right, let's hear it, Ed.
All right, so it's the investor club model to where, let's say I come in as an LP on somebody's deal and I bring 5 other people and they're in an investment club and they're all accredited because we're going into a 506C, or if it's a 506B, it doesn't matter, but they get counted individually. The question is, or what this operator told me is that on the back end, I, as the club owner or leader, he's already smiling, I can get some extra compensation.
For doing what?
Putting the club together in the form of equity, like, you know, extra equity.
Yeah. So so the question is basically, if I have an investor club, is there some way that I can put this club together, get investors together, and somehow end up with a piece of the equity, or is there some exemption because we're an investment club? And I've heard this question before, may even know the operator you're talking about. And the actual answer, let me give you the quick answer, then I'll give you the actual, dive into it. I mean, the actual answer is it's going to be facts and circumstances, right? So there is no magic exemption for investor clubs, right? At the end of the day, as I've always said, you probably hear me like a broken record, the structure itself doesn't matter. The SEC is going to look straight through any structure that you put together. And the question is going to be, are you taking money from passive investors where the results are generated by your efforts? That's the textbook definition of a security, and how you structure it doesn't matter. So with an investment club, I can see if you came to me and said, look, Mauricio, I want to put together this investment club. Can you help me structure it so that it is not a security, that everybody is actively involved? It's almost like a joint venture at that point. We can set it up. I mean, there is a way. Let me give you the easy way. I mean, if you had it has to be relatively small. I think if you have 30, 40, or 100 people in the investor club, it's going to be very, very difficult. But if you had a relatively small, you hear about these sort of older retiree, they get around and they have an investment club and they get together. But I can see a scenario where you have 4, 5, 6, 7 people that, sit around a table, once a month or however often, maybe now it's a Zoom call, but everybody, brings, hey, here's a deal I found for consideration of the group. And that gets, distributed to everybody in the group. Everybody really reads it first, and then you kind of go around the room and everybody's participating, does their due diligence, and there's an active discussion going back and forth, whether we like the deal, whether we not like the deal. And then if everybody truly is actively, and maybe on the due diligence side, everybody splits up some of the due diligence, right? I'll go talk to this person. I'll fly down. I'll do this. I'll do that. You could probably pull it off, but the returns need to be generated by everyone's efforts. And what you're basically doing, if you're an investment club, presumably is sort of a fund of funds, right? So you're pooling your capital and then investing in somebody else's operator, right? And so that's a syndication if one person is trying to put the deal together. But if all 4 or 5 or 6 or 7 are actively involved, where everybody participates in the decision-making process of whether to invest or not, then I could see it structured. The problem is, I know how most of these are structured. They're not structured that way. It's just like when I say, when you have a joint venture, people want to do it as a joint venture. And I said, well, you could do it as a joint venture. You'd have to do it this way. And they're like, well, I don't want to do it that way. I want to get paid. I want to get, I want to cut of the deal. I want to carried interest, and I want an asset management fee. And I'm like, well, those are all keywords for securities. And I think the same thing happens with an investment club. The bottom line is there's some, and I have it because I sent it to a particular operator, say this may be the same operator. There's actually a SEC, I'd have to dig it up. There's an SEC, not a press release, but there is a section that actually discusses investment clubs, and it specifically says that, you know, if there's one person running the show and there's a passive investment, it is going to be a security, but there is a way. It's a fact and circumstances analysis. There's just no magic pill. So I'd be very wary of going that route unless you vetted it through a securities attorney who's reviewed it and given, you know, their opinion or their thoughts on that.
Okay. Is that something you could set up for me if I wanted to do that?
If it's going to be reasonable, like what I described, sure. If you're going to end up
Yeah.
with 4 or 5 people, you know, then and everybody actively involved, and that's what I mean, that's really at the end of the day, really like a joint venture, right? You're just making sure ideally everybody's a managing member over there, right? So everybody's got responsibilities, and if it's a small group of 4, 5, 6 people, you know, and then the issue though, the other, just to go back a little bit, on an investment club, you have the issues of the fund of funds, which is in addition to the issues of 506B, 506C, making sure it's not a security. You've got to worry about all the other stuff we talked about, the investment companies. Although again, if you structured as a joint venture, you'd be exempt from all those. It's not a, it wouldn't be a security, but yeah, we can certainly talk about it, but I'll tell you how to structure it. You're going to have to say, yes, I agree.
Okay. Hey, I got one other quick one if I can
Yeah,
just ask.
absolutely. Yeah, go ahead.
Similar but different. Okay, so I've seen this. I had a student come to me today and tell me this is the offer that he was offered. There's 4 guys doing a syndication, and one of the guys, I guess, is coming on there as an asset manager and raising capital. And what his model is, and it sounds suspect to me, where he is going to bring in several people to hit that threshold of the commitment of $1 million or whatever. And let's say he's not going to get any additional funds for that. They're just going to come in together. Is that legal?
So if they're an asset manager, that's what the SEC wants to see. So if you're coming in and you're actually asset managing the asset, then you're obviously conducting substantial duties, right?
Right. But now, what I'm saying is you form an LLC. Let's say I'm an asset manager and I'm going to bring in 5 people that can't raise that much money because I want to show them the ropes and get them involved. And we all come in as one LLC and we raise $1 million, and it's all split evenly, you know, as or proportionally to the amount that we've raised. And that's it. We just come in as an entity.
It wouldn't be based on the amount of raise. If it was proportionally to the amount of the you guys contributed of actual cash, again, you can't get compensated for the raising the capital part.
No.
No, you would have to ideally, this is the way you fix this problem is before you start any of this, you guys, all 5 of you get together and you write a letter of intent or some memorandum of understanding, some document, nothing fancy, that just says, here are what the 5 of us are going to do. Here are our roles and responsibilities. And in exchange for that, we're going to get these percentages, right? And if you sign that ahead of time, DocuSign it, so it's locked in the date of you signed it, then it's going to be very difficult for somebody to then in the future say, well, you got compensated 12% because you brought in X amount of money. The amount of money that you brought in is irrelevant. Now, the problem is that what that means is that if you bring in $0, you still get 12%.
Yeah.
Because you're not getting paid 12% for bringing in the money. And then that's where people are like, oh, wait a minute, right? So again, it can be done. It's facts and circumstances. The issue I have is in most instances, it's just they're trying to get around it. But if you can get something before with all the roles, that solves your problem. Hey, I'm going to be the one that's liaising with the attorneys and the CPAs and I'm handling accounting. I'm the one that's going to be doing this. We're all going to get together on our weekly calls with our property manager, all the major, and we write it all out. And then we say, okay, well, Ed's going to get 25% for that because he's also going to bring in his own money. Yeah, Mauricio's going to get 15, somebody else. And you put that all ahead of time before a dollar is raised, and you're comfortable with that. And you're willing to run the risk that if I come in and raise 0, I'm going to get my 12%. If I bring in all the money, I'm still going to get paid 12%. Then you're good. But I have yet to see too many people willing to do that.
Or you take a finger or something, you know, if they don't raise it.
Maximo asks, what is an investment club? I mean, these are sort of informal, although maybe some people charge for it. It's just an informal gathering where, you get, in the example we are talking about, maybe 5 or 6 people, but I've seen investment clubs with 10, 20, 30, and this is the problem. But it's just everybody's getting together to analyze deals, find, share, analyze deals. You know, you've got different amounts of different knowledge. And then based on that camaraderie, just almost like a mastermind where you're analyzing deals. If there's a deal that somebody brings and people like, then everybody pools their money and invests in the deal. The challenge is when you have these clubs is that a lot of them are just, they're in the club and then they're like, yeah, this sounds great. Where do I put my 50 grand? And somebody's getting compensated for that, which is the problem. So, but great questions, Ed. Thank you. All right. Anybody else got? I'll start. Put up questions in the comment. I actually got a question today about there was a great question about Reg A's. I don't know if anybody really is interested in Reg A's. It's an interesting exemption that I'm seeing more and more people use. Back 5, 6, 7 years ago, whenever the updates were done for Reg A, nobody used Reg A because A, it was expensive, and B, you were limited to the amount of money you could spend, and with all the compliance you had to deal with, registering with all the states and making sure you're compliant with all the different states. Nobody used Reg A, but with the amendments that happened in this Reg A Plus, I think it was 2015, my memory serves me correct, more and more people are using it. So somebody was asking me for a checklist, and I know it's popular or it's enticing to have some kind of a checklist, but the securities laws are not really meant for checklists. I mean, it's a very, it's just somebody's got to do a thorough analysis of everything. But Reg A's, for those of you who don't know, and I'll spend a little bit of time on Reg A's as you guys put some questions on there. Reg A's is separate. It's different from a Reg D. So just like it's an exemption to the registration. And the nice thing about Reg A is you can actually advertise similar to a 506C, but you can also take non-accredited investors, which is awesome. Now, there's some limitations. You're limited to, 10% of their net worth or $100,000, whichever is less. So there is definitely some limitations to it, but it's a nice option. And the only reason it's not for everyone is, number one, it's a mini registration with the SEC. So it's a lot more expensive than a Reg D. Think, 6X, 7X, you're probably spending 80 grand or something for a Reg A. And there's a process, it takes 6 to 9 months to get it registered because you're going back and forth with the SEC and their lawyers and getting it approved. And so it doesn't really work for most of us who are doing multifamily. But I think with the advent of funds, more and more people doing funds and more people doing fund of funds, then because there's no deadline to raise all the money, you have the luxury of waiting 6 months or 9 months or sometimes longer for the SEC to get around to approving. And so it is an option. You are limited to 75 million. So if you're going to do it, I would definitely, one of my checklists was definitely make sure you get the $75 million in there, because you're going to be spending 80 grand plus just to get it set up. And then there's also the compliance ongoing. So unlike a Reg D, you're going to be required to provide audited financials. There's going to be quarterly reports, very similar to when you're a public company, you file your 10Qs. It's just a little bit not as strict and not as involved, but it's definitely something that entry reports, exit reports, quarterly reports, annual reports, audited financials. So there's a compliance cost to it as well. But it's something to consider if you're doing a fund, because it does, once you get that thing registered and you're able to advertise, having that option to take in some non-accredited investors is also a nice added benefit. And you can use social media and podcasting and all that stuff. So that's something to consider. But there's no magic checklist. You just want to make sure that you're working with your securities attorney. They know what the rules are. You're not going to be able to advertise until the Reg A is approved. And like I said, that might take 6 to 9 months. And I've heard it take longer. Kenneth, in reference to this investment clubs, this episode is going to be titled The Investment Club. In reference to the investment club, are the members active within the club's portion, or do they need to be active in the whole deal? They just need to be active in that particular deal. So the way it should work is, let's say we're an investment. There's 20 some odd people in the room right now. Ed comes to the room. We all meet today, and Ed's like, "Hey, I found this. I got this operator. I took a look at it. I thought it was an amazing deal. I think it's a promising deal," and distribute it to all of us 20 so that we can all review it and we can have an active discussion as to what we like about the deal, what we don't like about the deal. If I was running the investment club, I would obviously share that information before the call so everybody has a chance to review it. We can go through the financials together with the pro forma. And the idea is that everybody has different skills and things. And some people are really good with numbers, and some people are good with, maybe somebody knows the marketplace really well. And so it's just a way to share information. And then we decide, hey, there's 8 of us that like the deal. And so the 8 of us will get together in an LLC or some sort to whatever the investment vehicle is going to be and do the investment that way. So it's got its benefits, but you just got to be careful. It might be security, and that might not be the end of the world, especially if we're all accredited. It might not be a very complex, registration or whatever, but it is most likely a security when you have that many people, investing in a particular deal. But like I said, if you've got four people that end up investing, maybe that gets set up as a joint venture if we're all managing member, and we have all. What I don't want it to be, which happens a lot, is like Ed brought it in, and I didn't even show up to the calls. I didn't read any materials. I just know Ed knows what he's talking about, and so if Ed said it's a good deal, I'm going to invest as well because Ed said so. That's where you get into trouble with investment clubs. But if everybody's actively participating in the analyzing of the deal, it's possible as long as it's not a huge number. Maximo, for a new syndicator who has individuals willing to invest, what is the best course of action to find the deal, then start getting your funds together, or do a blind fund, then go hunt the deal? This is a general statement. There's obviously exemptions, but in my opinion, if you are a new syndicator, I would stay away from funds, certainly blind funds. And the reason for that is that it's much harder to raise money for a fund. So, I mean, theoretically, I guess if you said, look, I've already got 20 investors lined up for some reason, you could do a fund. But generally speaking, there's a huge difference between somebody who is committing, it's like, yeah, I'll put in 50 grand or 100 grand to actually getting that in the room. And it's just a really difficult thing to do as a new syndicator, unless you have a huge audience. I do have some syndicators who just happen to be YouTube influencers. And so, people think they know, like, and trust them, or do know, like, and trust them, I guess. And so they suddenly announce their first deal. Hey, we're putting together a fund. They've obviously got a lot of experience in that asset class anyway. Maybe it's single family homes, maybe it's apartments. I've been doing that part for years, but their first syndication. But if you've got a huge YouTube channel with a couple 100,000 people even, or podcasts that can reach a lot of people, then that's maybe the exemption. But generally speaking, I would recommend, Maxim, if you're a new investor, a new syndicator, I would find the deal first, lock it up, get it under contract, put together a nice business plan, and show your investors what the game plan is with that particular investment, and then actually raise the exact amount, or the amount that you need for that particular deal, as opposed to just say, hey, give me $10 million and I'll go find a deal, which is hard to do. But that would be my recommendation. It is generally my recommendation for new syndicators. But great question.
Yeah, I'll just make a comment.
Yeah.
Now, I did this with so I'm doing a deal right now with a partner that I've done like 8 deals with. Now, if I was the lead sponsor, I would have come to you on this.
I know.
But I just want to comment. I remember you telling me and 300 other people back in March of 2021 how the SEC came out with this new ruling that allowed you to start a 506B, stop it, and then do a 506C. Well, I did my first one like that.
Nice.
And I'm definitely going to do that every time now.
Yeah. No, it's a great tool. It's a great tool. And for those of you who hadn't heard about it, I forget the date now. I think it is March of probably 20. That sounds about right. March of 2021 when it became effective, that the SEC updated, it really overhauled its entire integration rules, which I don't know if I've done an episode on integration. Maybe it's just a little bit too nuanced. But integration is a general concept that you can't just take you can't just take one syndication and split it up into 2 in order to get around the rules, right? I mean, if you do a syndication and you get it to 34 or 35 non-accredited, you can't just be like, oh, I'll just start a different syndication and start my 35 again. The SEC will combine those if they're similar. And they used to have like a 5 checklist thing, to 5 prong test to see if it was similar enough for them to integrate it. But they completely revamped the integration rules. And part of that, or one of the things they added, was that if you were to start a syndication that allowed advertising following a syndication that didn't allow advertising, that they would no longer integrate those. And there were specific examples. If you start a deal under 506B and then start another one, same deal, they said substantially the same offering documents, basically the same deal, but then switch to a 506C so you could start advertising. As long as you're complying strictly with both of those raises, then you're going to be good. So what we do, and what Ed did, was started the syndication as a 506B, complied fully with 506B, meaning no advertising, no solicitation, have a pre-existing relationship generally, limited to 35 non-accredited, all that stuff. And then at some point in time, I call it a pivot, but it's what you're really doing is terminating that 506B offer. No more money there, no more documents. You've literally stopped that syndication, and now you're starting a new offering under 506C, even though it's the same deal, it's the same apartment building. I like to do separate shares. I don't know if whoever the counsel was that you use, I like to just, so it's very easy to identify when I'm raising under 506B, I'm issuing share A, and when I switch to 506C, I'm issuing share B, but it's not required in the rule. But once you start 506C, now you fully comply with 506C, which means you're only accepting accredited investors. You're taking reasonable steps to verify. Yes, you can advertise, but you're complying fully. And as long as you do that, and we've got some best practices, you want to document these things, and you want to create that proverbial Chinese wall, because you are literally terminating one offering and starting another one, then you're able to do that. And we've had a lot of clients that are using that, and it's a nice little thing, and it's just a great option that. So I'm glad you've used that, Ed. I think it's a great thing. Sean asks, what about tokenization and SEC requirements? We've done a couple of episodes, or maybe one episode. I did an episode. Actually, I got a really good video going over at Ken McElroy's channel, where I'm his legal advisor. So I did a video there, but we did one of the episodes on tokenization. And I'll give you the Cliff Notes version. I believe that I've been saying 5 years, whether it's 5, 6, 7 years, I think the majority of syndications will be tokenized. But tokenization is simply the digital representation of the shares. So right now we set up LLCs, right? Mostly LLCs. Some people set up LPs, but let's just say you create your syndication, you set up LLCs, you issue those membership interest to your investors, right? So an investor has 2.3% of your LLC, or 4.2, or whatever that is. Tokenization simply creates a digital representation of that 2.3% ownership and puts it on blockchain. And so the SEC's position on it, and the way that most of these deals are done today, it's the exact same rules, right? You still have to register that security, find an exemption, or it's illegal. And most people actually using 506C, because they're trying to advertise and trying to get to a bigger public. And Reg A is also starting to come up. More and more of them are being approved. But there's nothing magical about it. It's just a digital representation. And the promise is that it'll just make resales much easier once that infrastructure is set up. So the idea now is when you buy into a syndication, it's not a very liquid investment, right? That's one of the big risk disclosures in the documents, is like there is no stock market for you to go trade your shares if you decide to want to get out after something happens in a year, 2 years, 3 years. But there are marketplaces that are starting to develop in the digital world, where theoretically 3, 4, 5 years from now, it'd be very easy for you to say, hey, I invested in a syndication. It's a 5 to 7 year hold. Maybe it's a 10-year fund. But after 2 years, I want to sell. It's increased in value. It's been a good deal. I just need the money for some reason. That you'll be able to go on one of these third-party websites. That'll be sort of an exchange-like thing, where you'll be able to sell your shares for whatever the fair market rate is. And the nice thing with blockchain is that all the information that you would need in order to determine the value of your deal, rent rolls and debt and vacancies and all that stuff, can be stored on blockchain, which makes it trustworthy. And there's actually companies right now that actually will give valuations on these syndications every second. Like it's just automatically based on the cap rates, NOI, rent rolls, all that stuff that's on blockchain. So that's the promise of it. Again, we're very far away from it, but the term we use is STO. It's a securitized token, a security token offering, And we've done a couple, and they're out there. They're not super popular right now, but we get more and more calls about them. And I do think 5 years from now, I think that's the number I'm giving. 5 years, the majority, not all, but the majority of syndication, I think, will be tokenized. But check out it's one of the early episodes. I'm going to say episode 10, 15, 20 or so of the show. We did a whole episode on the tokenization.
Is it all right if I ask a follow-up question?
Yeah, please do. Please do.
Are you doing Reg A's with those? And then a follow-up to that is, do you see then, based on what you're saying, a secondary market where you think they're going to start bundling NFTs of properties and reselling them again?
Yeah, I mean, that's the promise. The promise is real. That's really that's really the main attract. There are other benefits of tokenizing your syndications, but the main one is really for the benefit of the investors, so that they can, it just creates a secondary liquidity. For the market. Yeah. And so And again, just imagine, you could theoretically do that today. Like, you don't need, again, nothing magical about these tokens. Everybody kind of gets thrown off. They're just a digital representation of the shares themselves. The challenge though, is that if let's just say let me a plug for my Facebook group. Let's just say my Facebook group, I said, hey, this will be an exchange. You can buy and sell, shares. I mean, just imagine I'm offering you my shares of something. How do you do your due diligence or figure out, whether I actually own it, or what percentage I own it? I always like to give the example is that, I could represent to you that I own 5% of the White House, right? And it's a White House is the White House LLC, right? Set up, and I can create fake documents showing the operating agreement for White House LLC, and I can say I own 5% of it, and look what it's worth, and blah blah blah. But there's no way for you to, if you're going to be able to go on a website and basically look around and click buy, just like you do on a stock, you have to have that information. You have to be able to confirm that information that, what are the rent rolls, what are the true distributions, what it's looking like. And all that's going to be held, as is on blockchain, which is going to make it much easier for people to trust the information and say, okay, this guy does own 2.3% of this company. This company has been distributing X amount of dollars. This is the property they own. This is the fair market value of that property. Here's what the cap rate is in that market. All that information is going to be stored in a reliable source. So that's the goal, and that's the promise. We're not there yet. But I would say we're not anywhere near there yet. Although some of them do exist. There's just 5 properties and 7 investors in there. So, but everything like this, it's an exponential growth. So I think it's going to happen pretty soon. But that's the idea. One of the ideas. Logan, sorry. Yeah, to continue Maximo's question, if we have 2 properties under contract where we want to develop self-storage, okay, so we've got 2 properties under contract where we want to develop self-storage, what would that be, one syndication or would that be a fund? Either way, I've had clients that do those in one syndication. They'll identify the 2 properties. We do create separate LLCs for those 2 properties, just because in case you want to sell one, not the other, there might be 2 different loan products. But generally speaking, we set up an LLC that owns the 2 LLCs that own the properties, but we'll raise them for both. Hey, we're raising $3 million to go acquire these 2 properties. Some people do portfolio raises where they'll say we're going to raise to buy 7 properties or 8 properties. So you could do it that way, or you could do it as a fund if you wanted to. So it's just up to you and how you want to structure. You could do a fund where you said, I'm going to go raise $100 million, and here are the first 2 properties we've identified for the fund. It fits our fund criteria. We've identified the first 2. Here's some information about the first 2. And then after we close on these first 2, we're going to buy more of these that are very similar to the ones we did. So you can go either way on that. Again, if you're a first-time syndicator, if I was a first-time syndicator, I may even recommend splitting those up into 2 separate raises, so they're smaller raises and there's just less hassle. But we have a lot of clients who will raise for multiple properties at one time. I call those portfolio raises. Great question, Logan. Andrew, for a 506B fund of funds, and I'll explain that in a second, for a 506B fund of funds to be eligible to invest in 506C deals, does the fund need to have $5 million raised from investors or just $5 million in assets under management? This is a common question. So a fund of funds, for those who aren't familiar with the terminology, just means it's somebody putting together a syndication or a fund where instead of buying properties, they're just going to invest in other people's syndications, right? They're going to invest in limited partnership interest in others. So I can put together a fund and say, I'm going to go invest in Ed's got a fund over here, or Ed's got a syndication. I really like it. I'm going to go raise $5 million in my fund, and I'm going to write a check for $1 million to invest in Ed's fund because I know Ed and he's great, and I've looked at the property, I've done my due diligence, I like that investment. You're basically almost like a stock picker. I'm buying shares in Apple, shares in Microsoft, or shares in Ed's LLC. But if Ed's deal is a 506C, right, then all of the investors must be accredited. That's the requirement of 506C. So that means my fund needs to be accredited. And there's 2 main ways that my fund can be accredited. And that's where this question really goes to. One is if every single member of my fund, every investor in my fund is accredited, that'll make my fund accredited. Or if my fund has $5 million in assets, however, that were not specifically raised for the purpose of the investment, and people miss that. So the idea of the $5 million of assets under management is think of a medical practice. let's say you got a bunch of, or an investment, maybe going back to the investment club, but you know, you have a medical practice where, you know, they have a building and they have assets, and those assets are, you know, that LLC has more than 5 million. Now with a doctor, most likely they're all going to be, maybe, well, with their student loans, maybe not. But if the entity has $5 million, or your trust has already $5 million in assets, then it becomes accredited, but you can't raise the $5 million and say, hey, I had an LLC that I just started last week and I raised $5 million. Now it's automatically accredited. No, it has to already have those assets because it can't be raised for the specific purpose of that investment. But that's an interesting question in terms of 506B to 506C, because that is one of the issues for these fund of funds. That's why the vast majority, Andrew, of the fund of funds that I see, there's a reason why those then end up being 506Cs anyway, because number one, they're trying to reach as many people as possible. So they're raising capital from the market. So they want to advertise, but it is possible to do a 506B with all accrediteds too. Everybody, that's another misnomer, by the way, that a 506B does not mean that there are non-accredited investors in that fund. In fact, the vast majority of 506Bs are accrediteds only, you know? So if you look at the big players, the JP Morgan, for example, let's take BlackRock, right? They have these tremendous funds that are billions and billions. You know, it used to be $26 billion real estate fund. I think they have a new one that's over 50 billion, I think. They're 506Bs. But all their investors are obviously institutional investors, and they're all accredited, but they do 506Bs because, you know, they all use broker dealers, and they rely on the relationships of the broker dealers. But just because it's a 506B, don't assume that there's not accredited investors in there. There are plenty of operators. We talked about Ken McElroy real briefly earlier. He does 506B deals, and they're all accredited. He doesn't take any non-accrediteds, but all of his deals are 506Bs. So, but anyway, that's one interesting scenario is when you have these fund of funds and you're trying to invest into a 506C deals. If you have non-accredited in there, you're not going to be eligible to 506C, which limits the pool of investments for you, which is one of the reasons why fund of funds end up being all accredited. Jennifer, would a Series 65 license circumvent some of these SEC rulings for capital raising? You frame that interesting. So a Series 65, I've been talking a lot about Series 65 recently because that's one way for you to become an accredited investor. So from the LP side, if you have a Series 65 license and you've registered with your state as an investment advisor and you're in good standing, then you are an accredited investor irregardless of how much net worth or income you have. Where it can come into play on capital raising is when you are doing fund of funds, because when you're doing fund of funds, one of the things we have to look at, in addition to SEC rulings and, you know, 506B, 506C, you know, that exemption, we have to make sure that we comply with the Investment Advisory Act, because what the SEC looks at is they say, look, you are advising your fund as to the purchase of securities because you're buying ED's LLC. I'm sorry, I'm picking on you, Ed. But ED's LLC is a security. So now your fund is investing in securities instead of real estate. It's a subtle difference, but that's the key. So everybody is considered an investment advisor. And so the question becomes, do you need to register as an investment advisor? The vast majority of states have exemptions to that, and you just have to look at your particular state. But in the event that you don't have an exemption, I just saw one, I think it was Alaska, and Hawaii is another one. We just talked about somebody up in Hawaii. Hawaii doesn't have an exemption. And so in order to do a fund of funds in Hawaii, you would have to register as an investment advisor. And one of the licenses that you would have to take is a Series 65, register with your state as an investment advisor. Now I'm going to be eligible to do a fund of funds because now I'm legally advising my fund as to the purchase of securities. But if you're in a state like, like Texas, for example, or you're in California, where there's exemptions to it, then you don't have to worry about Series 65 or any licenses. In fact, generally speaking, having a license may be detrimental to you. So if you don't need it, then you're probably better off not having it. I know a lot of clients who actually give up their license when they syndicate because they just don't want to deal with all the compliance headaches that their regulatory body imposes on them. So they end up giving up their license because they don't need it. Hopefully that answered your question, Jennifer. Logan Rogers, you talked about Ken's deals being 506Bs. What would be the benefit for doing a 506B over 506C in his case where most of the investors are accredited? Yeah, so the question is, why in the world would you do a 506B if all of your investors are generally accredited? The main reason is the verification. When you're dealing with more sophisticated investors or people who are putting in larger amounts, 250 grand, 500 grand, or even institutional investors, a lot of them just don't want to deal with having to show you their tax returns and their financials. If you think of it, all else being equal, if I'm looking at 10 investments and 8 of them, I don't have to show my financials and 2 of them I do, there's an inclination, you're a little bit of a disadvantage. And so I think just the investors are used to not having to deal with it. And a lot of people, including myself, aren't that thrilled with having to, share tax returns or, CPA stuff. And so that's the main thing. Because if you're not concerned about that, and you're somebody who does have, I'm a big proponent, actually, anybody who does have a huge audience, whether it be YouTube or a podcast, I generally try and steer people to 506Cs because you have such a great audience and you don't have to worry about any gray issues in terms of, hey, I've got a deal. You can say on your podcast, you can say on your show, I've got a fund and we're doing a webinar about it tonight. Here's the details. Come join us. You can't do that if you're doing 506Bs. But, Ken's been doing this for a while. He's got a pretty big list already of people. And at some point you get to the level where you have more interest in your deals than you've got spots. So you don't really have to worry too much about some of that stuff. So I think that's where Kenny is these days. He's been doing it for so long. All right.
May I?
You may indeed. Sorry, I'm sorry, Maximo. I saw your hand up there. I should have called you. Thank you.
I'm trying to be appropriate over here. So I want to piggyback off my first question for someone that's, looking to do their first syndication. And other people I've talked to said the same thing, is probably best to find the deal and then start doing the syndication. But I'm not familiar with the timeline I'm going to need. So if I were to stumble across a deal for the purchase contract, and I know this can be a wide range, but what do you see timeline wise? If you have some investors already kind of in your back pocket, as far as getting, the syndication done and the due diligence, what kind of timelines are you usually seeing?
Yeah. So, obviously once you get an LOI, you get into contract, and I would recommend getting in a contract as quickly as possible. I've seen that take as little as 3 or 4 days to get from LOI to contract, but I've also seen that drag out for a couple of weeks. And so step one is obviously get that contract in place. Once you get the contract signed, that's when I would have your securities attorney on board. I would talk to your securities attorney at LOI stage, start that pre-engagement phase. But just in case it falls out of contract, you don't want to go start wiring a bunch of money to your securities attorney and then realize, oh, the deal fell through. So, but I would recommend reaching out from a timeline perspective to your SEC attorney. Hey, I got into contract. Great news. Let's hop on a call. That's what we do. We hop on a call. And then once you get into contract, that PSA is signed, that's when we officially get engaged. And that's when we start all the processes. Generally speaking, we're relatively quick, but let's just say it's about 2 weeks from the time, you provide the first level of information for us. We have a questionnaire, but that preliminary information comes in. We take about 2 weeks to go from that stage to a draft PPM. And in that 2 weeks, in addition to drafting the PPM and going back and forth with you guys, asking you questions, we're also creating the LLCs. Most LLCs don't take 2 weeks. Florida comes to mind, that takes a little bit longer, and those may be a pain, but most states have either a rush service or take 3 to 5 days. It's not a huge deal. So by the time we're done with drafts, we should have LLC set up. Then you have to obviously set up a bank account, which shouldn't take too long. And so usually 2 weeks after that initial sort of information gathering, we have drafts. Then it just depends on how quickly, how many revisions you have to those drafts. Sometimes people get a draft and they come back and said, I'm revamping the whole structure. I know I told you I wanted to do this, but now I've decided I'm going to do, it's Ed, and Ed's decided to go do it from a B to a C, or, hey, I want to do a 1031 or some other, not crazy, but involved change. And that might drag out a little bit longer. But assuming it's like, nope, it's great. Let me review the docs, a couple of tweaks here and there. We would then probably have finals, in another couple of days or so. So the whole thing from start to finish, in terms of that initial call that I like to talk about, where we've already got some of your information, we're reviewing your business plan, we're going back and forth on the business plan. You're looking at about, I would say, 3 to 4 weeks total from the time that process starts to the time you actually have final documents that you're in a position to start raising capital from investors. And then, of course, that's the unknown. How long is it going to take you then to actually collect all of the money? And that's going to vary depending on how much it is, how strong those commitments are. One of the concerns with commitments, especially if they're really soft, is you may think you've got, let's say you're trying to raise 3 million, you may think you have $3 million raised, but when it actually comes time to get the money in, you have 2 million or 2.5 million. Or sometimes those funds are in IRAs, and it just takes, some IRAs take 3 weeks to transfer from their regular IRA to a self-directed account. That's a process. So it just takes a little bit longer. And the newer you are to syndication, the longer it takes. If it's your first syndication, I would give yourself a little bit more wiggle room, which is another reason I would recommend calling the SEC guys or gals right away, because it's going to take a little bit longer for new people. And that's the unknown for me is, we know we can get the stuff pretty quickly. But once you finish up your due diligence and you got those due diligence contingency waived, it's going to be a quick timeline for you to get to the closing table with all the money raised, which is one of the reasons that most of that work should go in prior to the deal. I mean, that's what you're doing when you don't have a deal is you're networking, you're talking to investors, you're communicating them with investors. So you're understanding what type of deals they want, so that when you find one, that timeline's a little bit shorter. You're not looking for new investors. You already have your investors in a group. And it's just a question of communicating putting the webinar together if you're going to do a webinar, or getting them the business plan.
And you can shop the deal prior to the filing, but you can't take money till the filing, correct?
So what we recommend is, I definitely would not show anything to the investor that hasn't been reviewed by your SEC attorney.
Okay.
We are okay with, once the business plan has been reviewed by us, and because we're going to go through various drafts of that business plan. And again, it depends on if it's your first time, it's probably got a lot of holes. If it's the 20th deal we've done together, probably less revising, but there's probably going to be 2 or 3 or 4 rounds of drafts going back and forth as we update everything and put more disclosures or get clarity. But once that business plan, once that pitch deck is finalized, you can send that business plan to your investors while the attorneys are wrapping up the PPM.
Got it. Thank you.
Yeah, of course. So I will, we'll see you in a couple weeks. Thanks everyone for remembering the new time. We'll see you in a couple weeks. Bye, everyone.
Aloha.
Aloha.